Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about investments. Very brief conversation on investments, and then we'll jump into a conversation about the statement of cash flows, which is a little bit more important than investments. So we'll only spend about 20 to 30 minutes talking about investments, and then we'll spend about an hour talking about the statement of cash flows. Uh, so the kind of a brief lecture today. So before we jump into the lecture, I want to quickly call your attention to the classroom. I've sent out several announcements and messages to all of you, letting you kind of know where we are and where we're heading, right? This is the final week of the course. This is week 8. As you know, this is an 8-week course. This is the week 8, so this is actually our last lecture together. Um, so we're in week 8 already. I know it's time flew by on us. It sure did. This week is the busiest week. We have to have everything done by Sunday night because Sunday night is the last day of this course, which means everything has to be done by Sunday night. Because next week, as you know, is spring break. I have to have your final grades in by Tuesday, not tomorrow, but a week from tomorrow. So what that means is I cannot accept any late work, period. Like we're talking everything, whatever you have outstanding. I don't care if it's 5 weeks late or a few days late. I need whatever you have submitted by Sunday night, period. Okay. Unfortunately I cannot make any exceptions on that rule because again I have to have your final grade submitted to the university Tuesday night. So please, anything you have left, I don't care what it is, it needs to be submitted by Sunday. That includes the final exam. So today we're going to talk about 15 investments, 16 statement of cash flows. So you have a very, very busy next few days in front of you for this course. I need to have 15 quiz, 16 quiz, and the final exam all done by Sunday night. Again, Sunday night is the last day I can accept anything from you. So at Sunday night, on Monday morning, this class goes into lockdown. So I literally won't be able to accept anything from you past Sunday night. We're all clear on that.
Yes.
Okay. So again,
Yes. Yes.
wonderful. Thank you all so much. So again, this Sunday night is the last and final day I can accept anything from you. So if you have anything that's late, anything outstanding, whatever it is, I don't care. I want you to submit it by Sunday night, period. I cannot go anywhere past this Sunday night. Okay? Because Sunday night is the last day of the class. So all of your remaining work must, and I repeat, must be submitted by this Sunday night, no exceptions. So that includes Chapter 15 quiz, Chapter 16 quiz, and the final exam. Everything must be in by this Sunday night, period. Cannot go a second past Sunday night. I just can't because I have to have final grades submitted by Tuesday. So sorry, I had to get on my soapbox for a second. So if you're scrambling, scramble. Let's get it done. It needs to be in. Okay, without further ado, let's jump into investments. We're going to talk about this for about 20 minutes or so, and then we'll talk about the statement of cash flows for about an hour. My plan is to have us wrapped up by about 7 o'clock tonight. These are very short chapters, and that's why we're going to breeze on through them. They're straightforward, relatively easy. Investments, it's not something that we talk about a lot in accounting because there's a lot of finance involved here. Finance and accounting are two different subjects, very different subjects, in fact. People think they're the same. They're not. The finance focuses on how does the company acquire things like loans or investments to leverage a business. That is a totally
I'm
different.
telling you, it's glass.
Sinead, do you have a question?
Oh no, Professor. I'm sorry. Excuse me. I
That's
accidentally
okay.
hit the unmute.
That's all right. No worries. So finance is a totally separate subject than accounting is. And in finance, they talk about things like the weighted average cost of capital, how does the business take out a loan or leverage investments in order to generate cash in order to finance the business. That's what finance is all about. This is an accounting class. There's a little bit of overlap with finance and accounting, and some of that has to do with things like stocks, bonds, um, and cash flows. So that's where there's a little bit of overlap, and that's why we talk a little bit about investments in an accounting class. Investments is not like your typical investments. We're not talking about investing to make a profit. That's not what investing is. Investing is more about holding short-term and long-term positions to help the business to generate a little bit of cash flow, but it's really about having stability. Um, so investing is not like the company is trying to make money on investments. That is not the point of investing. Investing is not to make a profit. It's to have security in the long run. So we're going to talk a lot about debt and equity securities. There's two kinds of investments that people make, or companies make. One is called debt investing, and the other one is called equity investing. And this is done in both the short term and long term. Debt investing is about a company uh, um, acquiring financing through debt, right? Like loans, bonds, and then equities is like stocks. So we'll talk, and we've talked about those things in the previous lectures, but we'll talk a little bit more about them today. A couple of basic motivations for investing. Get a little extra cash flow into the business, just a little bit. Some companies use them to produce income from investments, but it's rare. Again, the majority of companies, the reason why they have investments, like they'll purchase pieces of land, they'll purchase buildings, they'll purchase stock of other companies, they will acquire bonds and loans. The reason why companies do that, it's not to really generate additional income. The vast majority of companies do that for strategic reasons, or to have some type of leverage, or to have some type of security. And that's why companies invest. Companies invest in both the long-term and short-term positions. Short-term, as you know, is for like less than 12 months. Long-term, as you know, is greater than 12 months. When somebody says, oh, I'm in it for the short-term gain, that means that I am trying to generate some return on my investment in the short term, within 12 months or less. Companies might have short-term investments like stock in other companies. And they do that because they're trying to generate a little extra cash, or it's a strategic move. Some of you may have heard this thing called an ability to do a strategic buyout or to acquire another company. Those are usually short-term positions. And what they do is the company will purchase a lot of stock in their competitors to basically acquire them, right? And a lot of that's done through short-term holdings. Long-term holdings or long-term investments is what they call a long-term play. So it's like, my company likes to hold gold in the portfolio as a way to hedge against risk in the value of the dollar. Okay, that's usually a long-term play. And so that's more long term. That's kind of what companies do. Is they usually like to have a mix of short term and long term investments. Short term investing, it's usually things like stock. Management intends to convert it into cash within 1 year. In other words, they'll sell that stock within 1 year. And short-term investments are quickly converted to cash. Long-term investing, this is what they call the long. I'm in it for the long run, right? I'm sure you probably heard that before. I'm in it for the long run. Long-term investing is the company might purchase things like land and just hold on to it. They won't develop it. They won't do anything with it. They just hold on to it. That's an investment strategy because they know that that land will go up in value and then later on they'll sell it. Right? That's an investment strategy. Or sometimes a company might purchase another piece of land and think, hey, I might expand my operation on this, but then decide to sell it later on. That's a long-term investment. So property, plant, and equipment, those are typically long-term investments. If the company is not used, now here's the difference with investing and operating. Investments are assets that are held by the company but not used by the company to generate revenue. Investments are assets held by the company but not used by the company to generate revenue. For example, a company purchases a piece of land and does nothing with it, and the only reason why they purchased it is to sell it later on because they know it'll be worth more. That's an investment. And so that's what the difference between investing and operating is. So when you look at the financial statements, investments are under assets. So when you look at the balance sheet, toward the bottom you'll see investments, short term and long term, and that's where they're housed. And the reason why they're assets is because they can be converted into cash. Sorry. Short-term investments are quickly converted to cash. Long-term investments takes a little bit longer to convert it to cash. Let's talk about securities. A security is a form of an investment. A security is a form of an investment. Securities represents the vehicle of investment. A vehicle of investment. A vehicle is a finance term that is used to explain the type of investment. Debt securities are investments in things like notes, bonds, and CDs. Think of debt, right? A debt is a loan. A debt is something that is owed to someone else. You can purchase someone else's debt. That's what investing in debt means. You're purchasing someone else's debt. An example of that would be the company decided to purchase a government bond, which is a form of government debt, and the company will receive interest on that bond until it reaches maturity. That is a form of debt security for the company. The word security means I have secured it. I own that. That's security. Yeah? That's what the term security represents. Equity securities is an example of the company purchasing shares of stock from another company. For example, Target owns shares of stock in Walmart. Now, why would Target do that, right? It's like, oh, why would a competitor buy a competitor's stock? Right? You might think, oh, that's kind of weird. Why would somebody do that? The reason why a company might purchase a competitor's stock is to provide a leverage against that competitor. They might think about possibly doing like a hostile takeover in the future by acquiring that company stock. Ariana, do you have a question? Are you okay? Good. Yeah, long haul. Uh, yeah, Mike, I like that phrase a lot. I'm in it for the long haul. Uh, that's where the long term aspect comes into play. It's like, oh, I'm the reason why people have retirement accounts like a
Hmm.
401k is to be in it for the long haul. You say,
Hmm. Or
I'm going
or
to
another
purchase
phrase would
these stocks and hold on to them, right?
mhm.
So that's
And another phrase would be like, I'm in it for the long. I'm in the long game of it.
the long game. Exactly. Yeah. And people say it all the time. Oh, I'm in it for the long game. And so it's the idea is that you're holding on to those investments for a longer period of time, and you don't care about the risk. That hey, I
Yeah,
may go
it's
on.
like making like an investment in the stock market, or possibly like having a 401k or bonds or anything like that.
Exactly, Mike. Yeah, if you think of like your 401k account or your 403b or your whatever, your IRA, um, when you think about your retirement account, the market goes up and down every second of every day. Okay, like today it freaking I thought the sky was gonna fall. We lost 2% today. Yeah, that sucks.
Uh,
It's a lot.
with recent events, I mean, it's gonna happen.
Recent events have led us to lose a lot of money in the market. Absolutely.
Hmm.
Yeah, there's a lot of reasons for it. And but don't if you're in it for the long haul, you don't care about that because you know inherently the market's going to go back up. So you just say, hey, let's stick it out. You're in it for the long game. Don't touch nothing. Ride it out, and the market will go back up. And that's what in it for the long haul is. Yeah, good discussion. So companies invest in both, oh, small and or I guess, debt investments and equity investments. When a company is investing in debt, they are purchasing a loan from another company. They are purchasing a bond from the government. They're purchasing debt. That's what a debt investment means. They're purchasing debt, someone else's debt. Now you might think, why would a company do that? Well, because they'll receive interest, which is a nice steady cash flow, right? They'll receive that type of security. Right? So if the company, like if the debt defaults for whatever reason, the company could go in and acquire that. So that's another reason why a company might invest in debt. Equity investments is when a company buys a significant amount of stock of another company. For example, Target might purchase several thousand shares of Walmart. And the reason for that is maybe Target is looking to leverage against their competition. So there's a couple of reasons why a company might do that, but that's just one example. So in accounting, we look at either is it a debt or equity type of security? Does the company plan to hold on to that debt or equity security for the long or short term? And what is the percentage of ownership? So another example, and this one's a little bit more relevant. So if you think about Starbucks, Starbucks might decide, and they did this actually. There's another coffee company called Peet's, Peet's Coffee, and what Starbucks did, this happened relatively recently, a couple years ago. Starbucks decided to purchase. Um, First, they started with about 20% of the stock, so they purchased about 20% of the company's stock, and then they decided to purchase another 10%, and then another 10%, and before you knew it, they're the majority shareholder. And that was how Starbucks acquired Peet's Coffee. So that strategy helped Starbucks to grow as a company through acquiring another one through stock percentage ownership. So that type of stuff happens all the time. But it's just important that we know how to account for it. So here's an example of that type of acquisition. So let's say that our company has decided to purchase a bond from another company. So that type of entry would look like this. We purchased a bond of $30,000 with a 7% interest rate. It's 2 years and it's payable at par value. So we are purchasing a bond, okay? So we would debit debt investments because a bond is a debt. We credit cash to reduce our cash. We're buying a bond. And so over time, we will receive interest based on the bond that we purchased. So the interest we said was 7%, and it's for 2 years, and it's paid out semi-annual. So we would debit cash $10,050, and we would credit interest revenue $10,050. Now notice this, it says interest revenue. Interest revenue is a form of revenue. It's revenue that the company is earning based on the interest of the security. In this case, a debt security. But that is the concept behind the word interest revenue. It's interest that the company is receiving. It's interest that the company is receiving. And then when the bond matures 2 years later, we'll receive back the principal amount, what do we call it? The face value, par value. So we debit cash 30,000, credit debt investment 30,000. That's at the point when the bond is matured. So we would receive the face value of our investment back. Once in a while, the company might decide to hold debt for the short term, and the company will trade debt. This happens a lot in finance. So what companies do is they'll buy and sell debt investments on the exchanges. For example, if you've ever had like a mortgage or a car loan or even a student loan, so once in a while you'll be like, oh, the company sold my loan to another bank, right? So yeah, that happens a lot. That's a form of selling debt investments, right? They're trading it on the exchange. So like the next time you look at your loan, your student loan, and let's say you have it with Navient, and then it becomes someone else, a different lender. Navient sold that loan to another bank, and so that's why that happens. You'll get a letter in the mail. Oh, so and so is going to be taking over the servicing of your loan. Yeah, so and so bought your loan from that previous bank. So that's what debt investment trades are all about. Here's an example of a gain based off of the trade of a loan, and this is an example of that type of entry. Again, investments, we're just talking very briefly about the important aspect of it. It's more finance than it is accounting, but it's still important to understand. This is an example of selling a trading security. Debit cash, credit, debt, investment. And credit gain on the sale of the debt investment. held to maturity. So we know from our conversation that we had a little while back on bonds that when you hold something to maturity, that means we're hanging on to that investment until we receive the par value back, held to maturity. And so with a debt security like a bond, we would hang on to that until it reaches the date of maturity. And yeah, and that's the idea behind it. We're going to earn the interest, so we're receiving interest based on how long it's been held at the interest rate, and we will receive the par value at the date of maturity. Now this one is interesting. Available for sale. So a company might hold on to debt until it matures, just like we talked about. Or the company might decide to hang on to a debt and then sell it in the short term. And again, the reason for that is because the company might receive more by selling that debt in the short term than they would if they held on to it until maturity. For example, the interest rate goes up on a variable loan that the company purchased from someone. The interest rate goes up on that variable loan, so the company will decide, hey, the interest rate went up, now's a great time to sell it because I'll be able to get the par value plus that additional interest that it went up by. And so that's why a company might hold on to a debt and call it available for sale. In other words, they're trying to actively sell it to gain some revenue, some additional revenue, I should say. Anytime that a company sells something, whether it is an asset like property, plant, and equipment, or whether it is something like a loan or a bond or any other type of investment, the company needs to record its fair value at the time it's sold. So this is an example of the company recording the fair value. You debit fair value adjustment and credit unrealized gain when the value of the investment rises. If the value of the investment falls or goes down, we call that a loss. And so we would take the cost minus fair value to realize that loss. This is an example of a report on the fair value of an asset. So under your asset account, you know you have cash, accounts receivable, property, plant, and equipment, and then you have your investments like bonds, stocks, debt, equity investments that are held by securities. Some of them might be available for sale, some of them might be till maturity. But either way, we need to record its fair value amount. So it would be the investment at cost plus or minus, depending on what happens, if the value goes up or down, the fair value adjustment to equal the debt investment available for sale at its fair value. And think of fair value as changes in the market. So for example, let's say you're trying to buy a house and the value of the property continues to rise, which they are, then you would need to record that asset with the fair value adjustment. So when an asset is available for sale, we also need to recognize, of course, when it sells, what the value is at the end of that year. And this is an example of that. again, don't worry too much about investments. It's um, more for finance and accounting, but it's still, again, important to understand. Based on ownership percentage, this one's great. So I like this one because when it comes to stock, the more stock that you hold, the more influence you have. Okay? It's very simple. If you own the majority of the company, you have significant influence, or controlling influence for that matter. Here's how it works. Let's say we're Starbucks. I like coffee is, couldn't tell. Let's say we're Starbucks. And we are going to invest in Peet's Coffee. So I start off by making a couple small investments into Peet's Coffee Shop. So I'm going to purchase 19% of the outstanding stock, okay? Or the issued stock. I'm going to purchase 19% of it. That will give me insignificant influence over Peet's Coffee. 19%, it's a small amount. There's voting rights and all that, yeah, for sure, because it's common stock. But, it just doesn't have a lot of influence. So then I decided to purchase a few more shares, and I decided to purchase about 45% of Peet's Coffee stock. Now Starbucks has a significant influence over what the company does because they own 45% of the company. That's a significant amount. That is almost controlling. 51% of the company is controlling. Okay, if you own 51% of any company, you own the company. You are the owner. Okay, you are the controller. So you have the ability to have full control over the company at 51% or more. So then what Starbucks did is they said, hey, let's purchase another 10%. Now we're at 55%. That gave Starbucks controlling ownership over Peet's Coffee. And so that's how that kind of thing happens. So like when you hear about mergers and acquisitions, more often than not, that's how that type of thing happens. Adrena. Adrena, do you have a question? Go ahead and unmute your mic when you're ready. Adrena, are you there? You can all hear me, right? All off.
Yes, Professor.
All right,
Yes.
cool. Thank you. All right. Could just be an accidental hand raise button. That's all right. Okay, cool. Okay, so here's a couple of examples of those transactions I just talked about. So if a company has an insignificant amount of stock ownership in another company, they record that investment like this. So it would be debit stock investments, credit cash, to represent the purchase of shares of another company. So in this example, I think HP bought part of Linux, which is a software operating system. So that's what this kind of represents. And so one of the reasons, the reason why oftentimes companies will purchase shares of ownership in other companies is to receive a dividend. And as you know, a dividend is basically like a form of it's almost like interest, but it's not quite interest. It's more like a thanks for owning my company, payment. So we receive an interest every so often, debit cash, and we credit dividend revenue. The reason why it's dividend revenue, the reason why it's revenue is because an investment is an asset, and when I utilize that asset, I generate revenue, and so it's taxable because it's revenue that I earned outside of the normal operations of my business. So that's why it has its own line item being dividend revenue. And of course, I need to record the fair value adjustment at the end of each year as the market changes based on the value of the stock that I own. So I would debit fair value adjustment and credit unrealized gain. Or it could be the opposite if it's a loss. You don't like to lose, though. So this is what the reporting looks like on that fair value adjustment to your balance sheet. When we go to sell some of that stock that we have in the company, we debit cash, credit stock investment, and credit the gain on the sale of the stock investment. Could be a loss, though. Never know. But hopefully not. We don't like to lose money. With significant influence, again, represents 20 to 50% of ownership of a company. It's significant influence because that's a lot of voting shares, right? That's a lot of voting power. That's why we call it significant influence. Like that, the owner that has 20 to 50%, that's significant influence. Like they can almost control the board. If they had 51%, they can control it. Here's an example of significant influence acquisition. We debit equity method investment and credit cash to represent the purchase of $70,000 worth of common stock of this company. 30% of it. 30% is a significant amount of a company. And then, of course, I need to also record any earnings from that company, because if I own 30% of a company, I'm also responsible for that company's earnings up to 30%. So if the company earned $20,000, that means I've earned $6,000, because 30% of 20 is 6. And if we receive a cash dividend, which we like, debit cash, credit equity method investments. And the dividend was for $10,000, but we receive 30%, because remember, we own 30% of the company. So 10,000 times 30% is 3,000. This is what the book value looks like on these types of transactions. Again, don't worry too much about it. When I go to sell my significant influence stock, I debit cash for the amount sold. I credit the book value, and I credit the gain on the sale. Now, controlling influence. This is 51%, 50% or more, 51%. When you have controlling influence over a company, you own that company. 50%, 51% or more is controlling influence of the business. You're basically controlling the company at that point. That's what it's said to be under the parent company's control. So if we think about a company that has multiple levels, so let's say we have um, CVS Pharmacy, and under CVS Pharmacy we have.
Okay, sit back before my hands for the cancer. Well, and I canceled that one.
I'm sorry, Sinead, do you have a question?
No, no, Professor.
All right, no worries. Okay, so let's say we have CVS Pharmacy, and under CVS Pharmacy we have CVS Target, we have CVS someone else, Walmart, we have CVS whatever, right? Well, a bunch of the small CVSs inside the stores, right? Those are all subdivisions of the company. They're basically like their own small companies, but they all report back to CVS corporate. So that's kind of like how that works. Yeah. That's what we call entities under the parent's control. This is a nice cheat sheet classification of investments and the effect on the reporting. I don't like this one actually. On financial statements, there are, if you look at like a 10K report, you might find something like comprehensive income. Comprehensive income is kind of like the total income of net income plus any other income. That's comprehensive income. That's what we call comprehensive, right? It's all of it together. So it's sometimes on a separate financial statement called comprehensive income. And it represents the net income plus any other income. It wouldn't be a regular class if we didn't talk about a couple of ratios. So, when we talk about investing, we always look at what is the return on the investment, right? And that's always important to anyone, whether it be a company or whether it be an individual. We need to know what is the return. What am I going to get out of this, right? That's what the return is. So this one's kind of nice. It's called the return on total assets. We take the profit margin times the total asset turnover. That gives us the return on assets. So, in other words, it's net income divided by average total assets. Net income divided by average total assets. How do you find average total assets, you might be asking? We take the beginning balance total assets plus the ending balance total assets divided by 2. So you find the average total assets. This one's a cool comparison of Costco to Walmart and the return on assets for both companies. So it's interesting because, sometimes you might think, the profit margins, right? The profit margins at Walmart are in most cases higher than they are at Costco. But that's also because Costco gets the vast majority of their profit from the memberships, not from the products that they sell. That, my friends, is the end of the discussion on investments. Any comments, questions, or concerns about investments before we jump into the statement of cash flows, which is a little bit more important, so we're going to spend a little bit more time on that one. Y'all good? Okay. Let me stop this part of the recording, and then we'll start the next one. We'll jump right into it. Hold on just a sec.